Hey everyone, this is Kirk here again at Option Alpha. So this is going to be our 101 series for bear call spreads. We're going to go through everything: risk, profit zones, how to set it up, automation, and then we'll also go through a trade example while we're on this video. So let's first go through the setup of a bear call spread. Again, the naming is a little bit confusing sometimes because you will hear it named as other things. It's all the same thing. They're still talking about the same strategy. If you hear traders talk and use other ways of calling it, commonly it's referred to, or kind of like classically it's referred to as a bear call spread, but you'll also hear people call it a short call spread or a short call credit spread. Again, it's all the same thing. So the setup here is pretty simple. All you're doing is you're going to sell a call option and then buy a call option at a higher strike in the same expiration period. So again, you're selling a call option. Typically you sell it maybe like at or above where the stock is trading. And then you're going to go further up the option chain and you're going to sell a call or buy a call option further out than where you sold the original call option. Again, this is all done in the same expiration period. Now, this is a bearish call spread because we're doing this as an opening net credit, which means that the difference between the buy and the sell is a net credit into your account. You're collecting premium to get into this position. Doesn't mean it doesn't have risk. We'll go through that here in a second, but it is a net option selling strategy. And it adds a little bit of upside protection in case the security goes really, really high and starts to run away from you. That's why that long call option that was purchased a little bit higher up that option chain is valuable because it helps protect and cap the maximum risk in the position overall. So here's what the payoff diagram for a bear call spread looks like. Again, just kind of going through this, you have your two options that you're going to be trading. Let's just say, for the sake of this argument, that the stock is currently trading somewhere, I don't know, $45 or so. So the stock is currently trading at $45. You think that it's high or could stop going up, or is it a top, or whatever the case is. And so what you would do is you would sell your first call option here at a strike of 50. So this is where you would sell an option contract. And you can kind of see inside of this payoff diagram, this is the short call option payoff diagram that's kind of embedded here. So if you just had that one contract, you'd have a short call option here. Now, the problem with the short call option just generally, and I do not trade those, and I don't suggest you do those as a beginner either, is that you have undefined risk. So if you are just selling just the short call option without doing the spread component that we're talking about here, you have undefined risk, which is not good. So a smiley face and a frowny face on here, you have undefined risk. The stock can continue to go higher and higher and higher, and your risk just compounds for this position. So what you do in that case then is you do a bear call spread. So you still can sell that option contract here for 50 at the 50 strike, and then you go out to the 55 strike and you buy this option contract. And what that does is it creates this limited payoff diagram here where your maximum risk is actually capped. So if the stock continues to go higher than 55, it doesn't matter. It could go to 155, it could go to 255, it could go to 1,055. Your position is capped because you bought that call option at 55. And so all you're essentially trying to do is build a position where you can allow the stock to go higher. So if it was at 45, like we said, allow the stock to go higher, maybe even trade around the same range, and then hopefully move back down, or at least not go too high, and then you make a profit on this trade, okay? So let's talk about profit zones and risks on this position. I always like to do it this way because, again, I'm a visual learner, so I understand the payoff diagrams, but I know some people like to visually learn like I do. So this is what I was talking about here. Let's just say for right now that the stock, is trading, and it could be trading at 50. Let's just move it down a little bit. Okay, so let's say that the stock is trading right now. This is kind of all we see on the stock chart, or what you're looking at. The stock is trading at 45 down here. So what you would do is you would, if you thought the stock was going to stop moving up or not go too much higher or go the opposite direction, it doesn't always have to reverse. It just basically like doesn't go beyond your lines in the sand. Then what you would do is you would sell the 50 strike call. So here you would sell this call option, okay? And then what you would do is you would buy the 55 strike call option in this case. So there's many ways you can do it. There's many ways you can do the spread. You don't always have to do it the same distance apart. You can kind of move it around and massage it a little bit. I'll show you how to do that using Option Alpha here in a minute. But then what you get is you get basically a break-even point based on the credit that you received. In this case, you received maybe about $1 credit. So your break-even point is about $51. That is really kind of your line in the sand where you're allowing the stock to go higher. It can go to 51. Ideally, we want it to stay below 50. If it does stay below 50, then the stock is going to end out of the money and you get max profit. If it goes above 50 to 51, you're kind of in this variable profit zone. So when you get into this variable profit zone, you're starting to, kind of dwindle some of the premium that you collected because you did sell that call option at 50. So you're hoping that the stock stays below 50. But because you did collect a little bit of premium, you got this variable profit zone right in here. So this is kind of your variable profits where as long as it stays below that break even at 51, you still overall make money on the trade. Then you get into this in sometimes longer variable loss zone as you start to work towards your protection. And in this case, our protection here is at 55. So when that protection kicks in, our variable losses end and we're just left with a position that effectively ends in the money, which means that the position has gone through the strikes and our maximum loss is capped. So again, if you go back to the chart here, you've got your variable losses all the way until they get to 55. And at 55, things turn and start to shift sideways, and now your losses are capped. So that's effectively how it works. So as the stock is trading, let's say we get into this position, stock goes up a little bit. Let's say it even goes up to here. If this were the end of the expiration period or the period that you traded, this would be good. If the stock ended right here, you didn't get your max profit because it's kind of in between here, but it's certainly below your 51 strike or $51 break even point. So you still collected some money on this position. Let's do some more examples here. Let's say the stock just kind of moves sideways. This again, another good example of this. This, like when I trade a short bear call spread, this is sometimes what I'm thinking in my mind is mostly going to happen. I think the reality is some people think when they do a short bear call or bear call spread, call credit spread, they think that the stock is going up. And because they traded a bear call spread, they want the stock to go immediately down. And while that's nice and that would be amazing if it did go immediately down, the reality is that most of the time if stocks are going to go up, they're going to start maybe trading sideways or maybe not go up as fast. Maybe they go up, but then the speed at which they're going up starts to slow and they're still kind of creeping higher, but not at the same pace. Any one of those scenarios can definitely work for this position. That's why I like this strategy broadly, because you're still selling options. You're doing so with defined risk, and you're likely doing so with a higher probability of success. So again, if it starts to trade sideways like this, that ultimately is okay. It's fine that it does that. Now, if it starts to really go against you and starts to move up, this is when you start to get into that variable loss scenario. And it makes logical sense why that would happen, because if you're getting into this position, which is a bearish position, which you're hoping that the stock goes down or sideways, if the stock goes the opposite direction, that's when losses can happen on this strategy. So if you go here and then let's say that, we end the expiration period here, just kind of dragging the chart up. Let's say the stock ends the expiration period here, you'd be in max loss territory and you'd have to have that max loss attributed to your account, right? So even though you collected some premium, the stock moved completely in the wrong direction for you. And in this case, it definitely moved in the wrong direction for you. So you have to have a max loss in that position. Now, just because the stock moves up all the way doesn't mean that it can't eventually move back down or go back down a little bit. So again, this will happen sometimes as you're trading as well, where it might spend most of the month in max loss territory, but maybe just at the end of the expiration period, it comes back in and you can get some variable losses. Sometimes I've seen them come all the way back down where they come back into a profit zone. So they were up here and they were near max loss, and then they came back down into a profit zone. So there's no telling when this happens in the expiration period. That's why you just have to trade based on the stats and the numbers and control your position sizing and control your risk, because you don't ultimately know what's going to happen at the end of the period, and certainly don't necessarily need to get out of every single trade early as soon as it starts to go against you. Okay, so that's how it works out. So let's talk about finding trades. Now, before we talk about finding trades, which I'll show you how to do that inside of Option Alpha, the one concept that I wanted to tell you about is this idea of trade selection based on using expected value and things like EV and alpha. So let's review using the example from today. So let's say that we have that same bear call spread that we were looking at earlier, where you could make, at the best case scenario, $100, and worst case scenario, you lose $400. Now, this is not always a typical strategy or typical distribution of profits, but it definitely could be depending on how you set up a trade. Again, I'll show you examples as we go through. But now let's add some more context to this. Let's say that there's a 70% chance that the stock stays below 50. So we can calculate this out based on implied volatility and how much time is left, and we can get a good estimate on this. It's not going to be perfect, but let's just say at the trade entry, there's a 70% chance that the stock stays below 50. Now, most people, if they just heard this alone, and this is, I think, where a lot of traders fall and may take missteps on their trading, is they just look at this one specific number or a few specific numbers, and then they ignore all the other ones. This one's a very classic one because if I told you that this trade had a 70% chance of max profit, most people in their mind would think, okay, this is a great trade. I have to make this trade, right? This is a no-brainer trade, right? 70% chance of max profit. And let's just say down here, there's about a 25% chance of max loss. So low probability of max loss. That's never going to happen to me, right? That's the classic thing that happens. But what you need to do is you need to account for the fact that there is a 70% chance of a max profit and a 25% chance of max loss, and that the numbers here are real and known. We know how much we can make if we win. We know how much we can lose if we lose. So what we can do here is we can take this information and we can essentially create an expected value outcome. The idea that if we were to make this type of trade over and over and over again, is this type of trade with the distribution of wins and losses and probabilities the type of trade that we should be making. And you can see here that if I've got a 70% chance of making $100, that equates to about $70 of value. And I just need to add together the fact that I have a 25% chance of losing $400. Well, that actual calculation comes to a negative $100. So at the end of the day, this is actually a negative expected value type of distribution. If these were the numbers, I'm not saying these are the numbers all the time, but this is absolutely what can lead traders to getting into a good, what they think is a good trade with high probability of success, but not with a positive expected outcome, and pricing definitely not in their favor. Over time, someone in this type of trade is going to lose over and over again with those type of metrics. So let's just see if we can just, again, try to find an example here of just how these metrics might work. Again, we'll go through more examples as we get onto the Option Alpha platform. But here, let's just say that maybe the probabilities are different a couple days later or later on a different symbol, whatever. But let's just say that the probability of the stock staying below 50 is now 85%, and there's a 15% chance that it goes above 55. So now the distribution is a little bit different, and maybe it's a different security or whatever. It's just an example. But now if I take this math and I start to work it out, I've got 100 times the 85% chance of winning, which is about $85 of expected value. I subtract out 400 times 15% chance of losing. That's about $60 of expected loss. And so my net position is positive expected value. Now that is a much better type of position that you should get into because it has that positive expected value from the start. So how do we find these trades? Here's how you do it. You go into Option Alpha. This is one way to do it, and they'll show you if you wanted to. You could do this other ways, but this is the best way to do it, I think, is go into Option Alpha, go to Trade Ideas. Basically what Trade Ideas does is it goes through all these combinations of symbols, millions of combinations of symbols and strikes and expirations, and just pre-calculates information for you every single minute of the trading day. And so you can see Trade Ideas has already analyzed, at the time I'm recording this, about almost 60 million trades today. Okay, and we're about halfway through the trading day. What you want to do now is you want to start to filter trades that meet your criteria. So some of the things you might want to do are things like maybe you only want to trade ETFs. You're already trading a credit spread, and then we want to go over here and say that we want to trade a bearish position. Now you can see here that will give us these bear call spreads or short call spreads, as we call them inside the Option Alpha platform. This gives you all short call spread ideas. So immediately just these a couple filters, credit positions, ETFs only, and bearish positions. Now you get a huge list of potential trade ideas from which to work from. But again, we're not done here yet because we can do some other things. So you might want to also do things like probability of profit. Let's say I want trades that are 55% or higher probability of profit. I'm never usually a fan of doing the super, super high probability trades, like 85, 90% probability of profit. I don't always feel like they make sense from a risk reward perspective, but you do you. Obviously, you can make those changes. I like the 55 to 60-ish type range. So I'm going to do positions that are 55 or higher. I'm going to do a little bit further out in the time, so maybe 20 days plus. So I don't need to do any trades that are closer in. And then over here, I can filter for expected value of $5 or more. So immediately with this filter, I can say, look, I don't want to find any positions that have negative expected value. Now, you could find those inside the database. They're definitely there for different positions. If you just remove some of these filters here, you can see there's lots of trades that have negative expected value. Trade Ideas is not filtering any of these for you unless you filter them. It's just doing the calculations on lots of positions. But you can see here, like this position in XLV that I loaded up here. Notice that this is that short call spread payoff diagram here. But this position is probably not a good position to get into because you have a max profit of $48. Your max loss is $452, which is huge. Even though there's a 2% chance of getting to max loss, you've got this huge range of partial losses here. It just doesn't make sense. Like from a payoff perspective here, you can see that these numbers don't add up. The probability of max profit plus the probability of max loss and all the partial profits in between leads to an expected value on this type of trade of negative $5 and change and moving. And the key here is not that this trade will lose. That's why I think a lot of people think it's like, well, if I get into this trade, it'll lose. No, this trade could be a winner. You can make this trade a lot and you might have a lot of winners, but the math just doesn't suggest that over time, this type of trade setup is going to be a favorable setup. So you probably want to look for something a little bit more favorable. So if I were to come in here again, I would do some DTE filtering. So I'd go out just a little bit further. This is what I do personally on mine. I go probability of profit 55 or higher, expected value at least $5 or more. Again, you can do all sorts of different filters here. I'll add a link to this set of filters inside the video below so you can check it out for yourself. If you like any of these, by the way, you can save these as a preset. I use a couple different presets that I can filter for trade ideas. And then from here, you're going to go in and you're going to start to explore which type of trades might make sense to you. So if I go with this one here, you can see this one seems like it makes sense. Seems like it's a good position, 26 mid price. The bid-ask spread's a little bit high right now. We just kind of set this alert here that the bid-ask spread's a little high right now for that position. So maybe we'll take a look at a different one here. Let's do TLT, see what this one looks like. This one has positive expected outcome, so we check the box there, but risk reward is not favorable for this type of position. So again, we try to give you some of this information here. Looks like we need about a 45% risk reward ratio to really kind of make this favorable for max profit. So if you made this trade, you probably get a positive expected outcome over and over and over again. Certainly some better stats than the other ones we saw, but maybe not as great as some of the other positions. Let's actually go in here, and I'm going to filter this today by GLD. Now, the reason I'm filtering it by GLD is because if I'm going to make a live trade, I want to do a trade that I actually want to make on this video. And the one that I want to make is actually on GLD. So I am a little bullish on GLD. If you go over to a chart of GLD just really quickly, GLD is in an absolute tear parabolic move right now. Now, probably even just posting this right now and talking about this, a lot of people are going to say, well, that's crazy to make a bearish trade in GLD. How would you be so crazy bearish in GLD? I don't care. It doesn't matter. I'm not beholden to GLD or gold bugs or anything. I'm just making trades where it seems like the odds are a little bit in my favor. GLD has gone absolutely bananas parabolic. Doesn't mean it can't go up. But I can also make a trade that expresses my opinion and does so with good metrics behind me. By the way, if you just zoom out on a chart here of GLD, the parabolicness of the current position that we're in just gets even more amplified the further you go out. So all I'm saying is if I'm going to make a trade here in GLD, I'm essentially going to draw a line in the sand and say, look, I'm going to bet that the market can't continue this momentum, stalls and goes sideways or trades mostly sideways, maybe even down just a little bit. And if it does, then I make some money on this trade. But I'm going to do so in a way where I get some good metrics and good numbers behind my trade. So let's look at this first one here in GLD. Still looks pretty good, a decent trade. It's got about a positive expected value here. Still doesn't have that risk reward that we were kind of looking for this type of position. So let's go through and start to explore some more of these positions, see if we can find some that have some of that positive expected value and risk reward that we were kind of looking for. Okay, here's an interesting one. This one's a little bit further out, so maybe the profit metrics are a little bit better here, but expected value here is about $33. This is a November position all the way out in November, so about 44 days out. So it gives me lots of time for GLD to move into my range. You can see it's got that expected value. Probability of profit overall is 70%, which is great. and the risk reward is favorable for this setup, so it turns green. We're getting paid a little bit more money to take the additional premium out another month. So in this case, it looks like if we win on this position, we win $178. We lose the full amount on this position, it's $322. But I like this distribution here a little bit better than something a little bit more lopsided for premium. Notice that we do have that same payoff diagram here where you're selling the 380 strike. That's your short strike here. So if you look here, you're selling the 380 strike. You're buying the 385 strike. So that's my protection strike. And the difference between buying and selling is that mid price here, that credit of $1.73 and moving. So that gets me my break-even point around 381 and change. That's where I need GLD to stay below by the time we get to November expiration. Now, the cool thing is that if you wanted to see different payoff diagrams and different distributions, you can just kind of mess around with them here inside of Option Alpha. So you can just click and adjust these and kind of slide these around. Notice that if I slide them, the numbers are going to change dramatically as you go through this. This is what you should be looking at as you're trading. You shouldn't be just guessing at these. You should be kind of looking at these metrics and determining, do I want to make these types of trades in my account? I like this one. Again, small position, $322 of risk, small position for my account. So let's try to get into it. What I'm going to do here is if I like this position, I'll try that final price right around where the price is trading. Actually, we can probably change it down to 175. That's where the market's trading right now. I'm still going to use normal smart pricing, just fast, which means it's going to try a couple prices around 175, but that'll be the final price that I select. And then what I can do here is I can add this to a brand new bot. I'm going to create a brand new bot here just for this GLD trade. We'll call it GLD bearish bot. And I'll connect it to my live account. So we'll connect it to our TradeStation account. Give it a little bit of capital to work with for other positions, but you can see that I'm just creating a brand new bot for this position to be housed in. The last thing that I can do here is I can preset my exit options, which means that if I get into this position, I can immediately tell the bot that I want to take the position off when it reaches certain criteria. So I could say, look, if you ever get to 50% of credit, take the position off. I can even set a profit target to say, look, if I even get $100 of my profit, then take the position off. And then finally, if I get to expiration, I can set it to say, hey, I want to close the position maybe one day before expiration, right? And so all of this can be set here inside of your exit option settings. If you're trading in a small account and you have PDT restrictions, you can also check that box to make sure you avoid pattern day trading, which means that if any of these criteria hit, like a profit target or stop loss, if you use those, then it won't actually execute the trade until the next trading day, so you don't get tagged as a pattern day trader. But in this case, I can preset all of the ways that I want to exit this position, so 50% profit or $100 first or whatever the case is. However, these ultimately end up, whatever gets hit first, that's what's going to get hit. So in this case, what I'm going to do here is I'm going to say I want to get to, let's say if I get to $50 of profit, on this one, I can take the position off or 50% of credit. It doesn't really matter. You can use both. Actually, you know what? Let's just do this. I'm going to clear it. We're just going to do 50% of credit and just do one profit taking level here. So that way they don't conflict with each other. One might get hit earlier than the other one. So once you're good to go here, you're simply going to place the trade. Notice that the mark is trading around 180. So you can see it's trying at 180. I told it that my last available price was 175, but it tried at 180 just to see if it could get filled. And then you can see it had already filled actually, but it actually did fill at 177. So this is kind of the fun thing about using smart pricing is you can tell it what the final price you're willing to accept. Like this is my Alamo. This is the price I'm willing to accept. In my case, it was 175, but it was going to try pricing in between there, and it was going to work backwards through the bid-ask spread. If you actually go down to the position real quick, and I'll come back up, you can see the actual trade activity here, and you can dig into this, and you can see this where it actually tried 180, failed at 180. The next price it was going to try was 177. It did actually fill at 177. And notice that the final price it could have tried, like I allowed it to try, was 175, but it didn't need to because it actually already filled at 177. So this is a live trade in my TradeStation account. So this one's going now. So we'll let the bot manage it and take over the position, obviously. So you can see these are the metrics for the position right now. This is where we're at. I'm bearish on this position in gold. We'll see what happens as we keep moving forward. But this one's got a lot of time here, a lot of time until expiration. So I've got plenty of room for gold to move up against me and then come back down or trade sideways against just a high probability trade using good metrics. Now, the next thing that you can do inside of your bots is you can actually start to do some automation. So let's talk about automation here, because maybe you don't want to go find individual trades one by one like we did here. That was kind of like a hybrid approach that I just went through, where I found a trade, but then I used automation to manage the position using exit options. You can do something similar inside of your bots by just fully using automations. So let's say that if we are thinking about gold or any other types of positions, and we use RSI, and we know, or we believe that RSI is, a good indicator for us to use. You use whatever indicators or techniques or trading or whatever you want to use. But let's just say we're looking at RSI and we say to ourselves, look, if RSI on anything gets above 75, maybe it's a good opportunity to sell short call spreads. So if that is your strategy, you can actually automate that entire process inside of Option Alpha. So inside of Option Alpha, what you can do is you can go to your settings and you can add an automation to your bot. Now, when I add an automation to my bot, I'm basically just giving it a set of instructions to go through. So when I do this, I can say RSI over bot scanner, something like that, whatever name you want to give it. And what you want to do here is you want to have the bot start to loop through a series of positions or symbols and start to scan for those high RSI levels. Now, what I will do is I will loop through the bot symbols, which we'll set up here in a second, but just basically the symbols that I tell the bot to go through those symbols and see if any of those symbols have high RSI readings. So once I loop through those bot symbols, I'm going to add another action here, which is going to be a decision. And inside of that decision, I will go down to the indicator section, and I will see if the intraday indicator for a particular technical, like RSI, for example, which I think is the first one up here, but there's tons that you can choose from. Let's say that the RSI level is currently above 75. So that is going to be the decision that I want the bot to follow. So now what I've done is I said, look, go through whatever symbols I program in. I basically tell the bot what positions or symbols I can potentially want to trade. Go through here, and for every symbol, see if the intraday RSI reading is above 75. And if the answer to that question is yes, and that RSI is overbought, then what I want to do is tell the bot what to do at that stage. If the answer is no, I don't want it to do anything, so I leave no blank. But if it's yes, then I want to tell the bot to open a new trade idea. And I can tell it to find a short call spread or a bearish call spread. It's going to be in that exact symbol that was already there. I can tell it that it's completely optional what strikes it uses, but if I want to get into a position that, let's say, is at least 20 days out from expiration, I can set that. I can say, look, find me a trade that fits all my parameters, but it's got to be at least 20 days from expiration. I can set how I want the position size to go, the pricing, so how I want the orders to go through to try to get into the position. Let's say I want to use up to 5 cents of slippage from the mid. Again, I can preset my exit options here so that anytime I get into a short call spread, I know exactly how I'm going to exit that position. So I can set profit taking at 50%. I can set my expiration to 1 day before. I can always avoid pattern day trading. Now, again, no matter how many times my bot gets into a short call spread, it will continuously use these exit options as the way to manage the position moving forward. Now, the final thing that you can do is you can set some entry criteria here and some position criteria. This is basically your checklist of what type of position fits the criteria that you're looking for. So in this case, I'll say something like the bot has enough available capital. That makes sense. Don't try to force a trade because it's just going to error out unless the bot has capital. Make sure the bot has less than one position with this symbol. This is a really fun one too, because then it doesn't get into the same type of position over and over and over again. If it finds a trade for one symbol, it'll grab one position in that symbol. Down here in position criteria, this is where you can do a lot of stuff here. This is again like your shopping list or your checklist. You can say that the position expires before the next earnings report, no FOMC, no ex-dividend, right? Down here you can say EV per contract is greater than 5. This is a really fun one for me to do because I like doing this, where I can just program into my bot and tell it, look, don't even enter a position where the expected value is greater than 5. I can also tell it to have favorable risk reward for that max profit. That's that green kind of display that you see inside of your P&L or inside of your bot screen where it says that it's green, that's favorable for that max profit that you had. You just check a box and it'll make sure that the calculations and numbers add up so that you're not getting into trades that don't have favorable risk reward metrics. Then you can do probability of profit greater than something like 55%. Max loss per contract can be less than, let's say, $400, right? You're just putting it in. You're just saying, look, find me a trade that fits all of these criteria. Now, if it's true that you have many, many, many trades that fit this criteria, your last way of filtering here is just to rank them. So how do you want to rank any of those trades? Let's say you have 10 of them. Do you want to take the highest expected value, the highest probability of profit, the highest risk reward ratio? I usually go with the highest alpha because that's a risk adjusted version of that for Option Alpha. And then it will take that top trade and try to get into it. Now, once you hit save here, this is basically built your automation to do the entire process of scanning for those high RSI readings, getting into a position, and then you're managing them using exit options. So this is a very simple automation that you can run. Again, you just tell the bot what criteria you want to look for to get into that position. So once I hit save here, I'm now running this automation. I'm telling it to run as a scanner automation. I'm telling it to run all days, all market times. I can filter this down if I wanted to. And then once I add it, you can see it's added right here as an RSI overbought scanner. So the last thing that we have to do here is we just have to go through our settings. So our scan speeds, we can set to every minute. We can set our exit options to instant exit options, which will track instant pricing on everything. We can, of course, turn on the automations. But once we do that, we first need to set our bot symbols. So here inside symbols, what we can do is we can set the list of symbols that the bot is allowed to scan through. If you have a watch list, you can marry it up with your watch list and tell the bot, hey, look, go through my watch list. That's the list you want to set. You can create a new list, enter a custom list of symbols. You can then sort these if you wanted to sort them by RSI. So you can say, look, even inside my uncorrelated ETFs list, if I find many positions with high RSI, grab the ones with the highest RSI first. And you would put those in there and then just save this list. So now I have this list of potentially 25 symbols that have high RSI in descending order. That's a really easy way to find those positions constantly. And this list will update every single minute of the trading day. So as different levels change or as different symbols have different metrics, that list will be more dynamic as you keep going. And then finally, what you want to do is you simply want to turn on your automations. This allows the bot to run and continuously try to enter new positions. So again, that was a lot to go through, but you can automate that entire process. We've got a whole series in Fast Track on automation that you can check out at Option Alpha. But again, I hope you guys enjoyed this one on bear call spreads. If you have any questions at all, please let us know in the comments right below. If you enjoyed this video, give it a like, a thumbs up, a share. Get it into the hands of other traders who need to see this. And until next time, happy trading.